All right, good morning, everyone. It is 8:23 on the morning of January 9th, 2023, and this is my pre-market strategy session. And so today, I am focusing again on the Qs. The Qs have been pretty much my primary focus for trading for about a year now, and the the my bias is bullish again. Obviously, after a big 2.5% day on Friday, and also the Qs finding support intraday here, right at this Fibonacci that I have. Let me go to the monthly chart here. We'll take a look at this Fibonacci that I have on the Qs. And so here's the top of the Fibonacci, and that was at the end of November. And here's the bottom, which is November of 2021, sorry. And then the bottom I have down here in September of 2002. And according to this, Fibonacci, which, the things, the rhythms, it just works, Here we have the 68.2. Is that 68.2 or 68? Well, it's 38.2 here. So the way that I drew the Fibonacci, it's got a 38.2 here. Anyway, this is considered the golden ratio. A lot of people keep a close eye on this ratio. And here last Friday, it really touched right off of the golden ratio on Friday, and then took off in the other direction. And it's not the first time that the Qs essentially have found support right in this area, this 38.2 area, the 260, we'll call it roughly. Here we go, 1, 2, 3 areas of support here. And, that's, in my experience, it's a pretty good indicator of at least some short-term support for exploration to the upside. All right. Now, I will get really bullish if we can make it up above and hold up above 269.75, roughly 270, and we're above 270 right now in the pre-market. That is the line in the sand for the bulls right there. That's the next spot to defend. So today, if we open up and dip down below and then poke back up above this 270 line right here, I plan on getting long that number. And actually, it's overbought. We're technically speaking on the 10-minute, we're overbought. Let's see where we are on the 1 minute. On the 1 minute, we're overbought. You can see. And then let's see what the VIX is doing. The VIX is coming out of overbought. And on the 10 minutes, coming out of overbought. On the 1 minute, it is just kind of meandering around in the middle. Here's the deal. Don't fight the Fed, right? And so there's a boatload of economic data. I've got the Chicago PMI here. This is the Chicago PMI, and it's coming on. It's the Chicago PMI. You can see here has come off of a pretty nasty low right down here in the 37 area, and has popped up to 44.9. Now, 44.9 is still not good. I mean, it's still an indication of a contracting economy. Then we have the U.S. Bureau of Labor Statistics PMI. And it's down at 48.4, and its previous reading was above 50. Again, that's not good. That is contraction. The economy is contracting. However, in the world of the stock world, the idea is to front run the Fed. So if the Fed is going to stop hiking interest rates, or slow down even further from 50 basis point hikes to 25 point basis hikes, then 25 point basis hikes, then less hawkish, equals. I mean, it's hard to say bullish, but less hawkish is more bullish. I mean, if you have a choice of one or the other, the Fed is still hawkish, but the market is sniffing out the sort of rollover of the Fed, going from hawkish to neutral, something like that. So this Thursday is going to be an interesting Thursday here. Here we have January the 12th, 2023, and that's the next reading for CPI. It comes out at 8:30 in the morning, and it's the December 2022 monthly CPI reading. And so that will be interesting if CPI really starts to slow down and get closer to where the Fed is in its rate hiking cycle. The market is going to like it. The market is like, hey, inflation is coming down, and it's coming down to where the Fed is hiking. And once the Fed, once inflation, the CPI rate comes down, to match or even go below the Fed hiking cycle, the Fed rate, people are going to be like, okay, hey, smooth sailing. Don't fight the Fed. If the Fed is no longer hiking, then we can go on as business as usual, right? And then even if we start to go into a downturning economy, even if all the economic indicators and everything and employment, there are a whole bunch of layoffs and everything like that. Well, it's still, Wall Street is still going to be like, hey, we're front running the Fed. That's the number one game. That's the number one thing to do as far as being a portfolio manager goes, is being in front of the Fed. So if the Fed starts getting hawkish, or if the Fed is forecast to start getting hawkish, which they do, they signal what their intentions are, months ahead of time. And that's so that people can get defensive in their portfolios. Portfolio managers and hedge fund managers know to start hedging against their portfolio to cap losses. And so if the Chicago PMI, that's very bearish. That's not good. Same thing with the U.S. Bureau of Labor Statistics PMI. That's very bearish. The TNX, that's a very bearish indicator on the economy. The 10-year, 2-year spread here is still deeply negative, right? But that's if that means that the Fed gets less hawkish, that means that people are going to start preparing their portfolios for a neutral or dovish Fed, and so the things. The title of the video is "A Bottom, Not the Bottom." I don't think that we've quite seen capitulation on the markets yet. I think that there is further down to go. Once the 10-year, 2-year starts to normalize again, which means it starts to approach zero and then pokes up above, that's when we see the crash on the equity markets. But because it'll be risk off, but not until then. And in the meantime, there's been a gigantic, what you could call, correction so far, and the rest of everything is flashing big time recession and so on and so on. But the stock market doesn't care. The stock market is going to do whatever the Fed is doing. It's going to play off the Fed. That's it. That's all there is to it. So as of right now, the Fed is forecast to be less hawkish, and so when it comes to risk assets, people can be, portfolio managers and hedge fund managers can be more bullish. And so here we go. In my opinion, I think that this is just a bottom in a succession of bottoms, and it's not the bottom. I think this is probably just going to lead us into a leg up for the big crash whenever the 10-year, 2-year starts to normalize and liquidity is drying up big time. And then once the Fed announces that it's going to ease rates in order to sort of stabilize the economy for employment and inflation and so forth, then we're going to get a rip roaring rally after that. So in the meantime, it's okay to be bullish. Thursday ought to be a rather eventful day. The CPI read that we get on Thursday ought to be a market mover, no doubt about it. So until then, though, I'm bullish. I'm looking for the Qs to hit the top end of this range right here, possibly even break through it. We got a test of this 75% level. Now, 75% is not a Fibonacci level. We got a test of it here. We broke through here, broke down here, got a retest of it here. Went to the 38.2 fib, tested 3 times. Now, certainly the top end of the range on this chart is in play for the next week or two, and then I'll from there recalibrate, see what's going on with the relative strength indices, and see what we can do from that point forward as far as getting a trade going to either the upside or the downside. Here on the daily on the Qs, you can see the CPI is coming off the bottom here. It never really quite went into oversold. It's at the low is 33.33. There may be an intraday read. It's a little bit lower than that. Let's see. Let's go back to Tuesday. What is that? The 28th of December. Let's take a look at the 10-minute on the 28th of December. Let's see, 29. Okay, so on the 10-minute, we got a low down here of 27.26. So it did tap. Oh, I'm sorry. That's right. Here's the Friday, December 29, 28. Yeah, it went into oversold on the 28th of December. That's the low. And it struggled to close. It closed below that big Fibonacci that I had, but then the next day it rallied back up away from it again. So it's bullish. It's time to get long, which is nice. It's easier to make money on the long side than it is the short side. I will be playing the long side for the foreseeable future. Well, I shouldn't say foreseeable future. For the next 2-3 weeks, easily, I'm playing the long side. All right, everybody. Good luck out there. Keep your risk tight. Click like, share, subscribe, leave a comment, tap the bell, and I will see you at tomorrow morning's strategy session. Thanks for tuning in. I am out.